And what we do for them is they receive a loan, they negotiate a loan at $100 million, and they're not interested in dollars. They want to get Khmer Rio. So what we do is we transform that $100 million line into Khmer Rio so that your clients get a true local currency loan, and it can lend in real to the clients, and clients do not run this currency mismatch. So basically, opportunities certainly, because 43% of what we do on microfinance it is enormous. When we created the fund to absorb currency mismatch, we would have never expected that part of the industry to be so important. Infrastructure is much more the best to even, because we discussed about electricity, agriculture, etc. So now that being said, I'd just like to share with you a different view on risk-adjusted returns, because we talked about returns, but I heard very little about risk. So when I was trading credit derivatives, or I was a fixed income manager, the more money I made, the more I spent on overlays. So I had always some S&P puts struck out of the money, or I would buy cheap protection through CDS. And net, if I was making 10%, I would spend 150 basis points, maybe 200, just to hedge the tails of my portfolio. So what I believe is, when you invest into fixed income securities, because I'm a fixed income guy, you get paid for the credit risk you take, the risk, the rate risk you take, and finally the FX risk, and everything makes a nice handful, let's say 10%. In the equity world, private equity guys, you guys make money on the growth you can generate on the equity investment, plus the risk you take on the dollar. And I hear many of you, what I say is you factor in your model assumptions the volatility of the currency, and you say, well, the dong is an ongoing depreciating currency, I want to factor in 7%. So this is how I hedge my position. What I suggest is, at the extent of being a long or long biased and offering what I think is poor liquidity because you get locked up over 5 years, is if you can offer to your clients solutions where you demonstrate that you can hedge some of the risk, and currency risk is a risk, I think you can dramatically improve the risk profile or your investment proposal. And we've seen, it's been an empirical study, this is how TCX was launched 4 years ago. Frontier currencies depreciate all the time. So obviously you have exceptions, but the bulk of the currencies depreciate. So we recommend that risk should be hedged. You guys claim to be the best in what you do, finding great business or people to lead and command the business over a period of, let's say, 3 to 5 years. I would advocate that the currency risk is not your business. If it's not, you should hedge it and concentrate on what you do best.
Thank you very much. Henry, what are the specific ways that an investor can participate in the growth of financial services in Vietnam?
As we are aware of the commercial bank landscape, and also other companies like insurance companies or finance company, leasing company, etc. But for example, in the insurance business itself, it's a very lucrative business. Look at Warren Buffett started out with insurance, and then he went out with all kinds of stuff, brought tons of companies under his portfolio. He started somewhere with insurance, for example. But the insurance business is not something the average Joe can get into, because you have to have knowledge in the business. You have to have the expertise. It's just not tomorrow I want to to open an insurance company. It's not that easy. Of course, if a group of people want to have an insurance company, of course, or any business initiative to see, we can always organize and put together the appropriate resources to make it happen. But like right now, in each of these sectors, commercial banks, insurance companies, finance companies, leasing agents, and etc. Those are still wide open for people with the right mix, not only of the capital, but also with the domain expertise. Some banks, for example, I've talked to a number of banks. They want partners to come in. It's just the money. They want to be able to capitalize on the network, on the system that can add value to their current operation. Money alone, is not the solution. And even in other sectors, people want to look for a strategic partner that can add the breadth of their services and products. And so opportunities still there, but it has to be very selective. And with the trend of consolidation, as we see, which will continue to happen in the foreseeable future, if an investor that has the domain expertise, has the resources behind it, can capitalize on these opportunities and compete with even those that are established. But for the average investor, if you want to come in as a private investor, of course, then we have to look at the individual institution, the management, all those things that a regular stock investor will look at. But if you want to come in as a partner directly into a bank, then that's a different story.
Again, I'm going to offer a very particular slide. Is that if you're an investor, an LP or an investor that managing a fund, I think look into putting your money into the MFI, the microfinancing institution. Because as I mentioned, the opportunity for that market is in the billions of dollars. So maybe allocate part of your fund into a good, well-selected MFI in Vietnam. If you are a microfinance institution, again, look into Vietnam and try to identify the specific opportunities. Because I think this is where you're looking at a market that is in its infancy. And so there is significant room for you as a microfinance institution to grow. And if you are a microfinance institution wanting to look for opportunity in Vietnam, then I would like to offer that MobiV is a very good partner for you to talk to. Please come talk to me. I want to, an example is that we are in the process of building a network of the small retailers all around the country, and our objective is to get to about 50,000 of these guys in the next couple of years. And as I work through with these small business, this micro business, I see that there is a tremendous opportunity to fund their working capital. And you can start out with a $50 loan, and then within 6 months, all the transaction is going through the MobiV system. So we know exactly what their working capital is used for and what the volume is on a monthly, daily basis. Then you increase it to $100 and maybe max out at $500 to $1,000. And this is to me an opportunity so we offer a particular niche in this market. There are many different kinds of niches here, but that's to me an area where you can spend some money in Vietnam.
Yeah, I also want to add a few points here regarding the opportunities in the commercial banking business, for example. Of course, investor wants to come in and utilize the existing target company as the platform, in order to consolidate, not only to grow the company, the bank organically, but also to use it as a platform for further consolidation. I think that's also a great opportunity because there will be a lot of institutions, a lot of banks that will not be able to stand on their own. And if a prudent,
Microphone.
Oh, microphone. I think mine is.
Thank you. I'm sorry. Yeah, I think buying an institution, buying a bank, a single bank as a platform, building a platform, I think is also a great opportunity in this country. And so far, and I don't think there is. I met people, I talked to people who have that kind of idea, and
I think there's also a very selective opportunity for a prudent company and to capitalize on that opportunity as well. And as the secular trend continues to improve, of course, we see maybe 10 years ago or 15 years ago, mobile phone was not as widespread in use as right now. But financial products and services, as the middle class improves and more people get into workforce and their lifestyle changes, and of course the continued trend for financial service with faster speed of delivery, more options, more choices. It continues to grow here and Cambodia and other South Asian countries. So I believe still a lot of room for participants.
I do agree with what you said, and microfinance is an area of growth where you can make money. Proof is when we talk to our microfinance clients willing to hedge with us in local currency. When I hear the spread between the financing they get and what they charge to the clients, and even the cost base of these institutions, it's absolutely shocking. And in Europe, it's a big debate going on because we wonder these guys, most of them are funded by development finance institutions. This is where they get their money from. When you see they make 20 to 30% margin, not margin, but the difference between what they get charged and what they charge to the clients, in terms of ethic, it triggers a few questions. That being said, so that's for the opportunity from the risk side. If this is discussion Tanya and I had with some microfinance institutions in Cambodia, is you do your due diligence, you see that the duration gap is fine, the FX mismatch is fine, and you decide to invest in that company or in your platform because it serves all these guys. And then you say, well, at the end of the day, the credit worthiness of the end clients, the farmers, the investors, or the small businessman on the street is fine. But we advocate it's wrong. Because in Cambodia, most of these guys, they get paid in dollars, but the clients run a currency mismatch. So in a lot of Asian countries, by law, you can only provide local currency loans to your clients. But in some countries, these guys can still borrow in hard currency. So we reckon that unless you manage to see that the end clients of these microfinance institutions are not running this currency mismatch, as the microfinance institute should not, then you find it's certainly a great area where you should invest.
I want to jump into kind of the shocking number that we was talking about. So this is some of the specific data, right? For example, in my retail network, for every transaction, this shop make between 3% to 7% as margin for one transaction, right? And so the opportunity is that you can lend to these guys at a 0.1% to 0.2% per day, and you can imagine that 0.1 to 0.2% per day translates to whatever the number is. But still, these retailers they stand to earn so much more than their business costs, right? Because remember their margin is between 3% to 7% per transaction. So they still make on the order of 20 times what their cost is. And so this is where the opportunity lies, right? Is that if you provide to the right target, you help these guys to make significant returns. And in return, you make the return.
Okay, we've talked about some of the opportunities within the sector, and niches to exploit in the future as far as ways that entrepreneurs could make money. What about the way that the sector is right now? Do you think that it's an attractive opportunity? So I'm thinking more about the banks and about securities firms, which we haven't really mentioned yet. Would you put your money in financial services in Vietnam right now?
As mentioned, opportunities are there, but it has to be very carefully studied. It's just not any bank or any financial institution for that matter. I think new opportunities like mortgage banking are something that we also present ourselves as the housing sector continues to develop in the future. I believe mutual funds, for example, when the breadth of and the depth of the market continue to grow, to expand, those are also new opportunities. And if you come in as a private investor, taking a small portion, minority interest in the bank, the next question is, what your exit strategy, and how are you going to capitalize on your position to influence management or to influence the direction of the company? Those are questions that need to be addressed, to be answered. But if you want to come in and buy a bank or a finance company or a leasing company for that matter, to use it as a platform in order to consolidate, acquire other target companies, and pursue your growth strategy, that's a different matter. And so it really depends. For a small investor, if you want to come in and buy stock in a bank or a number of banks to build your own portfolio of financial service, holdings, that is easier to do. You can do your own analysis, with the help of local security analysts, for example. You can build a portfolio that way. But if you want to come in and buy a bank and use it as a platform to grow, then that is a totally different strategy. Of course, there's an option, there's a choice. And as competition continue to develop, companies, banks, and other finance companies for that matter will have to be able to compete head-on, not only on the product availability, the speed of delivery, the pricing, which must be transparent, and also the cost of services. Because right now, maybe there's a pocket, maybe a certain segment of the market that is still very attractive because of some mismatch situation. But as time goes by, then everybody will tend to come to a point when banks will have to compete, and those that have more salient competitive advantage will prevail. Those that do not compete well will have to be either bought out or maybe will fall behind.
Okay, thank you. Does anybody else have anything to add to that?
I think as always, it depends on your expertise and your risk appetite. I just want to offer some pros and some cons within the banking industry. So the pros is that, for example, today, the government just mandate that the long-term deposit interest rate is 40%. Right? They just mandate to you cannot go above 40% or your head will be cut off. Right? That's kind of and then the lending rate today varies between 18 to 20%, and some because they don't cap on the lending, so it can go anywhere between 18 to 22%. So as a bank, today you're in a great position because your spread is now from 4% to 6, 7, 8%, right? And probably there's no place in the world that you can get that much of a spread. So that's kind of the plus side, right? The other plus side is that you look at the potential of the market, and you can get excited that the penetration of the bank is so low, so it can only go up, right? So that, to me, those are the gravy. I think the challenge that you should weigh in this thing is number one is the regulatory framework is still evolving. So therefore, it adds uncertainty and it adds risk into the bank's operation itself. The number two is I think the transparency in terms of information disclosure, in particular the definition of the bad debt is still not very is still very fluid. So you don't really know what the exact health of the bank that you are looking to invest in. So that's the risk rate. And then if you and I think those are the couple examples that you have to wait, and as always is that you have to go deep into the due diligence process, but it's provide an interesting predicament of where and which bank to invest, but I think those are some the macro environment in between.
I think we're just about out of time, so maybe we can ask the audience if there's one or two questions. Go ahead.
Here's the microphone. Okay. So this is, I mean, I guess it's more for Jerome. We talked a little bit about this over lunch, but it's also for the panel. On the hedging, I guess I completely understand the fixed income side, where you have a notional amortization schedule, and you generally know time and amount. So you know maybe indicators of weighted average life, duration, and then you have a principal amount with interest payments, which make hedging that type of instrument not easy, but more sure. On the equity side, I mean, we're always returning dollars to our investors, and we're doing local currency, but we don't know the time. So we don't know if we're exiting year 3, year 4, 5, 6, 7. We also don't even know the amount generally. So we'd like to target our equity returns, but if we go under, we're going to have a different amount that we're going to have to pull out depreciated, or if we go over, we're going to have a different amount. And then the size that we're putting in is, say, 3 to 5 million. I guess what type of instrument would be economically viable to hedge in these circumstances?
That's a very good question. So as you said, two uncertainties that you don't have in the fixed income world. First, you don't know when you exit, time. Second, the notional, how much. So what we suggest is we just give the ingredients. I mean, there is no answer. The instrument we use would be a forward contract. And my personal opinion is you would go to hedge the notional, the initial investment. And then every once in a while, you review your assumption, because the closer you get to the exit point, the better is the visibility you get on your investment and how much you can crystallize, whether it's through an IPO or anything else. So what you could do is, at a certain point of time, let's say 12 months or 24 months time, you can readjust the forward contract. We say you roll the position. Only problem is, at that moment of time, you enter into a new contract, the market has changed, so actually under the, you enter in a financial product where the value of the contract has changed. FX rate goes up and down, the rates, so you have to take that into consideration, so you're not perfectly hedged. So this is how we would assess or recommend to do it.
A quick follow-up
Yeah.
to that. What is the pricing on that? Is that, in general, like say for Dom, is it economically viable on a $3 million exposure?
Well, on pricing, it depends on your expectation. So a forward contract, typically, you pay the difference between the hard currency and the local currency. So this is the cost of carry on the position. So if you think that actually the currency is going to depreciate more than the market expectation being the term structure at in T0 when you enter the contract, just go for it. If you think that the market overstates the devaluation of the currency, I mean, there is no point hedging. So it all comes to, first you should understand the three components of the contract: the hard currency term structure, local currency term structure, and the FX spot when you enter into the contract. If your assumptions are different than the market expectations at that moment of time, you can arbitrage the market and say the market underestimates, so I go long, or the market overestimates, I do nothing.
Follow-up question on that, hedging. As an investor, we are invested in Vietnam, obviously, and to hedge that risk currency. How far do you go on a forward contract, and do you do that on an NDF basis? What's the size that you can hedge for us? And my other question is, as a firm, who protects you on the other side? Are you bound by ISDA and we get protection after that, or do we take credit risk on TCX? you know, because normally if we hedge through a bank, obviously I have some credit issues there, right? So what can you offer us as LPs investors in Vietnam?
So I just forgot one point here. Maturity, credit. Okay.
Thanks.
So maturity in Vietnam, I mean the genesis of TCX is we exist because there are no other commercial alternatives. So I'm going to give you a simple example. 6 weeks ago, I received a price request from a client of mine to hedge a Kenyan shilling position. They got a price from Standard Chartered and Barclays. But because the guys know that these guys, they can be pretty dodgy and the market was a bit volatile, they say, hey, we have a good relationship, we're a shareholder of yours, what do you quote on the 5-year tenor? We were 20 bits cheaper than Barclays. Barclays is the house in Kenya. But we said we do not interfere and disrupt local markets. So you have access to these guys trade in the market. If they came to us and they said, we want to do an 8-year transaction where there is no market, we would be the sole or the last liquidity provider. So this is what we call the principle of additionality. We would use our capital only to make a market for shareholders and their clients only. So you Goldman Sachs knock on my door tomorrow to say, hey, I want to do this. I'm not committed to quote, and actually I'm not going to quote. So this principle of additionality is we would make a market where there are no commercial alternatives. On the tenor, in Vietnam we quote up to 15 years, Cambodia 4 years, Mongolia 2 years, and most of the Asian currencies 15 years. The only currencies we do not quote yet is very long-dated tenors. Is Bhutan, Myanmar, and Laos. These are the only 3 countries we do not quote. On size, minimum we do is 1 million before we say it's a hassle. So we don't go and chase these tickets. Average size is $3 million, and the largest ticket we printed was around 50 million. And on the credit worthiness, I mean that's a key element, and I'm glad you mentioned that. We're not in the business of taking credit risk. We take market risk. Our shareholders, they are the development banks, 23 institutions, they are in the business of taking credit risk like microfinance institutions. We do not. So when you enter into a swap with TCX, problem, you create a second order credit risk. Because a swap forward is a living animal. The market of the contract will change every day, every minute. So if I'm in the money, actually I'm sitting on let's say 1 million mark to market because the currency appreciated. So if you were to default, I have a problem because I would need to claim that million. This is what I call a second order credit risk. And the CSA will mitigate that. This is why we have always CSA's agreement in place.
When I talk about credit risk, I was talking about we're taking your credit risk.
Okay, but we A-. We have 100 million capital with a book of 160 million, so we one-time leverage. So, but this is mitigated through the CSA because this is a bilateral agreement. So we would decide how we post collateral on a monthly basis.
Yeah, that's my point. So who backs you at the other end? In my previous life, I was head of global markets for Standard Chartered in the region. So we trade a lot of this stuff before. So if there's no one backing you on the other side, it's very difficult for you to hedge investor on the one hand. And if you're not bounded by financial institution regulations like those kind of contract, it takes a heavy burden on LPs to make investment and hedge a currency to a third-party provider.
Yeah, the who backs up Goldman Sachs, the Fed, on the Treasury. I mean, it's a very good point. And don't get me wrong, we A-,
Sure.
and we think that with the capital we have, we can certainly address.
All right, so let's get specific then. If I'm hedging $10 million for 5 years, Vietnam don't know, what would be my price today?
I can get back to you on that and give you an indication. The point is, if you don't have a link with one of our shareholders, you don't get access to TCX. Because we only provide liquidity to our shareholders and their investees, so understand their clients. The whole idea is the friends of our friends are our friends.
Okay.
Okay, obviously there's a lot of interest in how you can hedge Vietnamese dong. I think all of us investors run into that problem all the time. So thank you for that, Jerome. I think that's it for today. So I'd like to thank the panel for their insights. I'd like to thank everybody in the audience for their attention late on a Friday afternoon. Thank you very much.
Thank you very much. Up next, we have final remarks from Gary Gibbons. Dr. Gibbons, that's right.
Brevity being the soul of wit, I'd just like our friends from BCCI to come up. These folks are very professional. They worked hard on our conference, and we want to include them in our thanks. Also, we want to include the Auxesia team, so if they could come up, please, because they also work very hard. Successful conference with us. We certainly feel that way. We very much appreciate every single person in the room coming. We appreciate the sponsors and the speakers and the panels. We try to make our conferences more topical and more disciplined than some of the other conferences you could go to. Really appreciate it. We'd like to thank all of these people because these are the people that make it happen. So we are officially at an end. Thanks.